In today's video, we're going to talk about mortgage programs and the costs to buy a home here right in Minnesota. I'm Travis Anderson, and I'm with Peter Lindquist, a great mortgage broker in the Twin Cities, who's going to help us uncover the costs to purchase a home and the loan programs available. Hey, Peter, how are you?
I'm doing outstandingly well today, Travis. How about you?
Same. Yeah, that's great. Thanks. Can you tell us about the different mortgage programs and what a consumer might be curious about those programs?
I'm going to focus today primarily on first-time buyer programs, but a lot of these you don't have to be a first-time home buyer in order to qualify for. In general, there's two main types of programs. There's conventional financing and there's government insured or guaranteed financing. Conventional is actually the most popular. It's the hardest to get. Generally speaking, you need better credit, you need lower debt to income ratios. Government insured loans have a great purpose in today's market. FHA is very common. FHA tends to be more liberal when it comes to credit scores, and what you can qualify to. VA loans are just an outstanding benefit if you're a veteran and qualify for one. There's no reason not to take a VA loan. And then there's USDA loans, which are for more rural areas of Minnesota that are zero down.
What about the down payment requirements for each of these programs?
Yeah, so let's start with conventional financing. Conventional financing requires a minimum of 3% down for first-time home buyers. And that's actually lower than programs like FHA, which is 3.5% down. On a typical $300,000 purchase price, 3% of that is $9,000. And then for closing costs and prepaid expenses, closing costs are what it costs to pay everybody who's going to help you get the loan. Prepaid expenses are what it takes to set up an escrow account for taxes and insurance. You want to account for another 3 to 4% of the purchase price to account for closing costs and prepaid expenses. So a total purchase price of $300,000 would be 3% for the purchase, and let's say 4% for closing costs and prepaid expenses. That would be conventional financing. The variances on the other ones are FHA is 3.5% down, so a little bit more for down payment. VA and USDA are 0% down. That doesn't mean $0 out of your pocket, because remember I mentioned closing costs and prepaid expenses. Those are the same. So you still have to account for those when you're buying a home. So with a VA, you might think in terms of around 4%, or USDA about 4% of the purchase price. You've got to account for that.
One thing clients often ask me is about mortgage insurance regarding conventional specifically. And, you mentioned 3% down is sort of a minimum requirement. People can put more down, of course, with conventional. Can you touch on, some of those different down payment options with conventional, and at what point do we benefit from dropping off that insurance cost?
When you're buying a home in general with conventional financing, if you have at least 20% of the purchase price as a down payment, we consider that good. You don't need to pay for any mortgage insurance. Mortgage insurance protects the lender in the event of foreclosure. It has nothing to do with mortgage life insurance or, whether the house burns down or not. It has to do with whether you're making your payments or not. A benefit to mortgage insurance is that if you don't have 20% as a down payment, it allows you to get mortgage financing. Okay. I have so many buyers who say, well, I hate mortgage insurance. And I'm like, okay, but there's a benefit to it because it allows you to buy with less than that. Conventional financing separates the cost of mortgage insurance based on credit scores. Better credit results in lower mortgage insurance premiums. There's actually several ways to pay for mortgage insurance on a conventional loan. There's monthly mortgage insurance, or you can pay it as a lump sum and never pay it again. But if you have 20% as a down payment, with conventional financing, you don't need to pay it. People commonly ask, when can I get rid of mortgage insurance? And typically that's once you have at least 20% equity in your property, which is commonly, 2 to 6 years down the road before that were to happen. That's conventional financing. With FHA, mortgage insurance just always is. 20% down doesn't matter. You're still going to pay it. VA doesn't have mortgage insurance. They have something called a funding fee. USDA does have mortgage insurance, but it's the least expensive of all of them.
So Peter, you mentioned, of course, let's say I'm a first time home buyer and I'm using 3% down, and now I've got 3 or 4% in cost to close and prepaid expenses, which is 6 or 7% total of a purchase price. And when we're looking at a $400,000 home, that's quite a bit of money. How does somebody get assistance to offset some of those costs?
Yeah, that's a great question. Most people will refer to this as down payment assistance, but it's entry cost assistance. There are many programs available to first-time home buyers, and some programs available to buyers who are, we call them step-up buyers. They've bought a home in the past and now they're moving up. With conventional and FHA and to some extent USDA, there are programs that can benefit buyers that reduce the amount that you're going to use to buy a home down to as little as $1,000. I'm speaking specifically of the Minnesota Housing Finance Agency, otherwise referred to as MHFA. If you're buying a property in the state of Minnesota, it's a program that I automatically look to see whether you can benefit from it. They have programs that will lend to you money up to $18,000 for that matter as a second mortgage on the property. That means that you're borrowing money to help offset the amount of money that you need to buy a home. You need to be able to put in at least $1,000 of your own money, but the rest of it can come from entry cost assistance or seller paid closing costs or gift money, and therefore it can get down to as little as $1,000. Entry cost assistance from the state of Minnesota is by far the most common, but there are other programs that are available in local communities as well. Many communities, not all, but many communities have additional programs that you can combine with the entry cost assistance that you get from the Minnesota Housing Finance Agency. And you're always bringing in at least $1,000 of your own money, but are reducing your monthly payment and or reducing the amount of money that you need in order to be able to buy a home. So if you qualify in every other way except for the amount of money that you need to buy the home, that's the kind of program that I'm going to look for is entry cost assistance.
Sounds great. And do you examine this with every application you get with a buyer then?
Yeah, I remember talking to a realtor 20 years ago or something, and they were so mad because they said, why don't you lenders just do that automatically? Buyers, 2 weeks into the transaction say, well, wait a minute, how about down payment assistance? And by the way, that's too late. You have to have known it up front. So basically over the last 20 years, I make sure that I'm reviewing those options at the point of initial contact to see if there is a benefit to a buyer. Not all buyers qualify. And if you're just a first-time home buyer, all of these programs have maximum income limits. Some of them have maximum asset limits. So if you have a lot of money or you earn a lot of money, chances are you're not going to qualify for entry cost assistance. We automatically look that up for you. A lot of people will do a lot of research online and that's great. But you can also just call me because I do that all day long. It's part of my role is to be able to see what kind of benefits you might get from entry cost assistance.
A moment ago, you mentioned seller paid closing costs. We've also touched on it in a previous video. Can we expand on that a little bit more here?
Yeah, so seller paid closing costs are a feature that can be used with most mortgage programs and can benefit many buyers. As an example, I mentioned $300,000 purchase price, and we talked about 3% down, 4% of other costs. That means $21,000, right? If you're not getting entry cost assistance, let's start with that. You've got, and you need $21,000. One thing you can do to offset some of that cash out of pocket is to inflate the purchase price and ask the seller to contribute money towards your closing costs. Let's say the house is 300, you offer them 309,000. If they agree to that, you're asking them to pay $9,000 towards your closing costs. The benefit to you is that instead of 21,000, now you need 21,000 minus 9,000, you need 12,000 in order to buy the home. That's the basics of seller paid closing costs. It can work with FHA, VA, and USDA as well. When I mentioned you can get this down to as little as $1,000, that requires both entry cost assistance and seller paid closing costs. There's some benefits, but I want to make sure that everyone understands it doesn't mean that it's just a pure benefit to you, because remember, the key here is you're inflating the price for the seller to pay it. So you're paying more for the house. You're basically paying your closing costs, and then the seller's paying them so you can build it into your loan. So that's one thing to understand. Second thing is, if you're negotiating on a property and there are multiple offers, it can be very difficult to be able to negotiate seller paid closing costs. Wouldn't you say, Travis, sellers kind of just tend to throw those offers away?
As a realtor negotiating contracts, use your exact example. If you offer somebody 309, ask them to pay $9,000 in seller pays, the home now has to appraise for that 309,000. So even if you're not competing with anyone else, you are changing the terms of the purchase agreement, or you're trying to negotiate a term of a purchase agreement that may affect the ability for that buyer to qualify. And so it's just important that to understand for a buyer, number one, it is negotiable. Number two, that means that the seller doesn't have to agree to it. It is a good way to offset some of those costs, but it isn't always necessary. There are some challenges with it. You and I have talked about this before. I wish we didn't call it seller paid closing costs. I know that that's what it says in the purchase agreement, and I know that that's the language that you have to use as a lender, and there's a lot of regulations around this. But the truth of the matter is, the way you described it is the best. You're inflating the purchase price to cover your own costs. That's the best way.
While we're on this topic, I want to dismiss a common myth, because I'll hear this from buyers and realtors. Well, we'll just roll closing costs into the loan. And they always use this term, roll closing costs into the loan. And it doesn't work that way. The only way it works is to increase the purchase price and have the seller pay it. There's only one mortgage program where you can take closing costs and put them on top of the loan, and that's USDA. Very rare program comparatively, and that only works if the house appraises high enough that it allows you to do that. But there's no such thing as financed closing costs.
I think that about sums up. I mean, we talked about the different types of programs. We talked about the down payment required for most of those programs. We talked about the costs associated with obtaining the programs, and we went into a little more detail on how to offset some of those costs. Is there anything that we haven't touched on that you want to talk about?
The last thing that I want to share with people is, if you qualify for a mortgage and you're saving money for down payment, call me, because you might look at it and say, well, wait, I can qualify to buy a house today using some of these structures, whether it's seller paid closing costs or a combination with entry cost assistance. There's no cost to getting the information straight from a mortgage lender. And I'd be glad to be that mortgage lender that would help you with that.
It's never too early to get started.
Yep, I would agree with that. So thanks a lot, Travis, for talking with us today. And we've looked at all the different kinds of programs that you need to know about when looking to buy a house in Minnesota: conventional, FHA, VA, USDA, and down payment assistance. Thanks again for taking the time to be with us today.
Yeah, thanks, Peter. Have a great day.